Somewhere in America, a massive portfolio changes hands tonight without a single trade being placed. No panic selling occurs, only signatures, lawyers, accountants, and quiet transfers behind polished conference doors. Yet the consequences may permanently reshape every major asset market across the United States. Stocks, housing, bonds, private equity, infrastructure, and farmland are already feeling the pressure. Most Americans have never heard of this silent trillion-dollar financial transition, but they are already living inside its consequences every single day. Home prices feel increasingly detached from ordinary salaries and household incomes nationwide. Markets remain elevated despite endless warnings predicting imminent collapses and painful corrections ahead. Wealth appears to concentrate even when the broader economy feels fragile and uncertain. This is not random. It is generational mathematics unfolding quietly in real time. Over the next 2 decades, an unprecedented transfer of wealth will transform American finance. Older Americans will pass assets to heirs on a scale never witnessed before. Estimates range from roughly $80 trillion to nearly $90 trillion. Some long-term projections push the total beyond $100 trillion. Numbers this large become almost abstract to the ordinary human mind. But their effects are deeply tangible throughout everyday American economic life. Houses receive new owners instead of appearing on public market listings. Investment accounts move without triggering widespread forced liquidations or disruptive market shocks. Businesses remain within families or carefully designed trust and holding structures. Capital stays invested, simply shifting into younger hands and perspectives. Economists call this phenomenon the Great Wealth Transfer. The phrase sounds ceremonial, almost like a formal family announcement. In reality, it represents a structural event affecting every asset market. It is among the largest reallocations of private capital in history. The silent generation built substantial wealth after the Second World War. World War II reshaped industries, incomes, and household balance sheets across the entire nation. Baby boomers then expanded that wealth through decades of economic growth. They bought homes when prices remained connected to local wages. They invested during long bull markets and falling interest rates. Many accumulated assets beyond anything previous generations ever experienced. Now, they are entering their 70s, 80s, and advanced retirement years. The average boomer controls far more wealth than younger households. Much of that wealth sits inside appreciated residential real estate. Another large portion remains in retirement accounts and pensions. Additional wealth resides in taxable investment portfolios and businesses. Eventually, ownership of all these assets must change. Mortality is unavoidable, but market consequences depend on family choices. Families decide whether to sell assets or continue holding. Increasingly, they are choosing to keep what they inherit. That seemingly simple decision changes everything across markets. One imagine a family home purchased decades ago for $200,000. Today, that same property may be worth $2 million. Selling immediately could trigger a significant capital gains tax bill. Inheritance often resets the tax basis to current market value. Heirs can keep or sell with fewer tax consequences. Many decide to hold the property indefinitely. Some convert inherited homes into cash-flowing rental properties. Others view them as permanent stores of family wealth. The house never returns to the open market. Prospective buyers lose one more opportunity to purchase. Multiply this process across millions of properties nationwide. Housing inventory becomes structurally tighter year after year. Prices remain supported even as affordability deteriorates sharply. Young families wonder whether the system has turned hostile. In some metropolitan areas, it nearly has. The same mechanism also affects financial markets. Brokerage accounts pass directly to named beneficiaries. Mutual funds and index funds often remain fully invested. Stocks are not sold, they are merely reassigned. Demand persists while available supply barely increases. This creates a subtle yet powerful floor beneath markets. Trillions remain continuously invested across multiple generations. Younger heirs receive capital they never personally saved. Investing suddenly begins with a substantial built-in advantage. Wealth compounds from an already elevated starting point. Those without inheritances begin significantly further behind. Merit still matters, but starting capital matters more. The economy increasingly resembles a relay race. Some inherit the baton while already running fast. Others are still tying their shoes at the start. Private businesses are affected by this transition as well. Family-owned firms transfer ownership without public offerings. Private equity firms position themselves to acquire estates. Trust structures preserve control and reduce tax exposure. Wealth becomes more institutional and less publicly visible. Farmland is also entering this transition. Large agricultural assets pass to heirs or investment funds. Scarce, productive land remains increasingly concentrated. New farmers face rising barriers to entry. Ownership quietly narrows across essential economic resources. Headlines celebrate democratized investing and broader financial inclusion. The deeper story is inheritance-driven capital reinforcement. Markets are increasingly supported by legacy wealth. This helps explain persistent asset inflation. It also helps explain widening inequality. Not because younger Americans refuse to work, but because ownership increasingly depends on family history. Capital is becoming hereditary economic infrastructure, like a private bridge collecting tolls forever. Some families own the bridge outright. Others pay simply to cross it each month. This transfer will not solve every economic challenge. It may actually intensify financial and social divides. Asset holders receive even more assets. Non-owners face higher prices and reduced access. Markets appear healthy, while opportunity becomes less evenly distributed. The system remains stable, yet increasingly unequal. Quietly, ownership is rewriting America's financial landscape. The largest market force may not be innovation, policy, or interest rates. It may be who inherits what when those final signatures quietly and inevitably arrive.